The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, and welcome to our weekly market deep dive for April 26th, 2021. Starting with commodities and currencies, as we usually do, it was a very good week last week for several commodities. Starting with the commodities on the right-hand side of the table here, or the set of charts, you can see crude oil held its ground, but more importantly, copper, which has been termed to be the best real-time gauge of GDP out there, was up to a 10-year high last week. Additionally, corn was up 12% on the week, and many of the ags were up strongly. So again, commodity reflation is definitely the trend that continues. That is partly being egged on or spurred by weakness in the US dollar, which you can see here in the center of the chart. The red rectangle shows a weekly chart of the greenback, which is failing or being repelled at its 40-week moving average. You can also see the stochastics are not oversold. And so we believe the dollar still has room on the downside and is likely to test this all-important 90 area in the weeks ahead. Should 90 break, which we're not predicting, that could lead to a significant round of devaluation by the dollar and continued strength in commodities. Looking a little deeper at both oil and gold, we have the Brent crude contracts on the left, the 1 month and the 12 month. And you can see that Brent remains above the down trend line that it broke several months ago. This is good news for oil. This suggests oil goes higher from here. And again, to see a little bit of pullback to test a trend break is very common and healthy action technically. Gold is a little bit different of a picture. You can see gold has been weak for several quarters now, and we use the spread between the 5-year forward and the break even, or the 5-year forward and the actual yield, and the 10-year break even and the actual yield to project and get a read on where gold prices may go in the future. Usually they move in concert, which is a good wind at the back of gold. But recently you've seen the two diverge, and we think it's a little bit more of a structural headwind for this commodity within the patch. Looking at bonds and interest rates, starting with the daily chart in the top left, you can see that yields remain weak, but not that weak. They've pulled back over the last month or so. But again, that pullback has been very contained, very mild-mannered, compared to the very, very strong rally from 1 to 1 3/4% on the US 10-year. That move was important because it took it back through this area of 140, which was a huge area of support both in 2012, 2016, and ultimately broke in 19. So again, to get back through that area is the significant development on the chart, and it's very bullish and supports the reflation theme longer term. Looking at yields globally and our yield curve in the US, you can see that the yield curve isn't changed much over the last month. The green solid line is very close to the dotted olive or brown line, but yet while it's unchanged over the last month, it's definitely steepened over the last 6 and 12 months, which again is a good thing because it's a sign of economic activity. The market controls the long end of the curve, and as rates rise, it's the market telling you they are expecting inflation. Well, inflation is only generated by economic activity, so it's good to see the long end of the curve rise. Globally, you can see with the green rectangle how yields have behaved over the last year, which has been strongly higher. They were mixed and little changed on the week, but again, since the low in March of 2020, all are higher. These dominoes that have fallen in sequence were first the US 10-year break even, which really rocketed before the low in March. It took a couple months, but then the US 10-year actually started gaining some traction. A couple more months and you saw the British 10-year finally start to move. And just recently, the German 10-year has moved as well. So again, global 10-year rates rising strongly, and they're doing it in sequence, starting with the US. Looking at credit spreads, they were also mixed and very little changed on the week. We track 3 spreads between investment grade bonds, high yield bonds, and triple C bonds compared to the US 10-year. The numbers on the right are the advantage in yield each of those vehicles gets. And you can see that yields have come down dramatically since the COVID low as well. They're down near cyclic or typical cycle lows, and in some cases, historic lows in the case of investment grade spreads. Investment grade spreads recently were only 1.06% above the US 10-year Treasury, which was a record low even compared to 2007 and 2008. The point being, yields are not offering a warning sign, or spreads are not offering a warning sign to the market. They're in fact a tailwind, not a headwind. And the risk over the short term might be a pop in spreads, which could lead to a pullback in stocks. But again, we believe any pullback would be a buyable dip in the market and something, a consolidative factor or consolidation range within an ongoing bull market. Looking at a long-term view of the US Value Line Index, you can see going back to 2002 that the value line has seen several market cycles. We use the red and green vertical lines to provide buy and sell signals. Those are generated when the percentage of stocks within the value line cross above, or percentage of stocks above their 200-day average cross above the 40% threshold and below the 40% threshold. While a lagging indicator, it does a very good job of keeping you on the right side of the tape. You can see that we did get that buy signal in the mid-2000 timeframe. Again, a little bit late, but it's a confirming indicator, and certainly the market is up strongly as measured by the value line, up from 6,000 to 9,500 if you'd taken that signal. Currently, the number of stocks above the 200 is remaining quite strong and historically strong, up in the 80% range. This is about the longest period of time on record that has occurred, which means this is a particularly strong bull market. Think of something like the 1950s or the 1990s, and you probably have a good comparison. Looking at a little more tactical view of stocks, you can see daily charts on the left, weekly charts on the right, and several different indices on the right-hand side, including the Dow Industrials, Dow Transports, Mid-Cap Index, Small Cap Index, and then the ratio of small cap stocks to large cap stocks as defined by the Russell 2000 and Russell 1000. Looking at the daily chart, you can see last week was kind of a quiet one for the market, but you can also see it was not negative in any way, shape, or form. Stocks remained strong and in a tight range. And again, this looks like one of the bullish flags we've been talking about in things like copper, in things like the Bloomberg Commodity Index. Typically, when you have these short-term consolidation patterns, the market emerges in the same direction it was heading when they come out of it, which would be to the upside. So while we do think stocks remain strong over the short term, market internals are starting to diverge on the NASDAQ, not necessarily on the S&P yet. And you can see here what I mean. Looking at the daily chart, the number of new 52-week highs has remained rock solid as the stock market has advanced. On the NASDAQ, however, as you've gone back toward 14,000, you've seen far fewer new 52-week highs, meaning there's a bearish divergence there. Now, while not fatal, it does suggest that certain groups are starting to weaken as you get extended. And by extended, look at these weekly charts. Look just how far the S&P 500 is above this purple dotted line, or its 40-week moving average. Again, pretty extended, which long-term is healthy, but certainly cause for concern over the short term, as you could enter one of those digestive trading ranges that we've been mentioning. The divergences are prevalent on the NASDAQ on the weekly chart as well. As the NASDAQ has made an equal high at 14,000, you still are seeing a little bit of a divergence in the advanced decline line, as well as the number of new highs. Now, certainly this could be corrected if the NASDAQ breaks out strongly, but until then, it's something to keep us on guard. Finally, speaking of strength, if you look at the charts on the right, you can see the Dow Industrials has made a nice run over the last quarter, the Dow Transports as well. And in addition, the mid caps, small caps have gone sideways, but they were the leaders the last quarter of last year. What's particularly noteworthy is, again, those transports. They were up for the 12th straight week last week. When you start coupling that with the strength in copper, the strength in corn, as we mentioned, when you have containers or boxes strong as well, it definitely points to a cohesive picture for strong market action and economic action in the days ahead. As for the sectors last week, I've sorted them by highest return in this table on the left, and you can see that the tone of the tape was slightly defensive last week. And by that, I mean REITs and healthcare stocks were up near the top, and some of the more risk-on groups were down near the bottom. Now, it wasn't a full defensive week, and the utilities were still down near the bottom. But again, populating the top, and the top by a wide margin, were healthcare and REITs, which is slightly defensive. I also put a dashed green line on the table to the right just to show the strength in the market. And if you look at the numbers within that green box, that's how far this sector is trading below its 52-week high. 0 meaning it's at a 52-week high, and you can see it here in the chart of the REITs, which I'm highlighting with my red pointer. So again, many, or the vast majority, I should say, of sectors and even indices are trading very near all-time highs, which is a bullish sign. As for the volatility surface, not much of a change last week as well. There hasn't been much of a change the past few weeks, as you can see by the difference in this table on the right. If anything, there was a little bit of a decline in near month long dated or calls that were far out of the money. So again, think near in time, but far out of the money. They saw a little bit of selling or a little bit of decline, which makes sense with the defensive nature of the tape. Regarding sectors, that also matches as what we're seeing in the sector charts, in that the discretionary stocks have seen an uptick in down skew and a decline in up skew. That's a very risk-on group. And so that getting more negative is cohesive and consistent with the picture we've been seeing. Similarly, real estate and utilities, being more defensive groups, are seeing volume skew increase and down volume skew decrease. So again, the defensive stocks or defensive sectors are seeing that confirmation in the options market as well as the relative strength charts. As for the stocks or groups we'd like to highlight this week, I call it clean and green because there's so much attention right now in the media with the Biden infrastructure deal. How much is going to get passed? What can people agree on? And will there be a deal at all? And right now, the market does seem to suggest a deal is there and a deal can be done. I've put 6 popular ETFs on this slide. TAN, or the wind energy ETF, TAN, or the solar energy ETF. iClean and PBW are more general, but again, alternative energy ETFs. NLR and URA are more nuclear energy, certainly clean energy. The NLR is mainly focused on utilities, and URA on the uranium and the mining stocks that actually get out of the ground to drive those utilities. The point I make is the top 4 are a very consistent picture, in that they've all had both strong gains since the COVID low, and then pretty mild, not mild-mannered, but reasonable pullbacks that seem to be holding. The reason I like to look at these groups is because, again, if they were breaking down to new 52-week lows, that would suggest these stocks are on the defensive and that deal might not get done. The fact that it's holding at these levels suggests that it's been a viable pullback in a bull market, and that they're still telegraphing that this deal with some sort of infrastructure will get done, with an emphasis toward alternative energy. As for the overseas markets, a pretty consistent picture to what we've been seeing in the past few weeks. The developed markets continue to grind higher. The emerging markets are a little bit more mixed. And most importantly, we like to look at one of those other C's, China, to see how the market's holding up. Remember, China, as you can see from the green rectangle or the box here, those ETFs were the first to break out last summer. They really led the market higher and gave us a great window into the health of the recovery and the health of markets worldwide. Those ETFs have been pulling back over the past several months, but as you can see by the green circles, they pulled right back to areas of support, right back to their 40-week moving average, and they're holding rock solid. A lot like those energy ETFs on the previous slide. So again, while you can argue this is, of course, an actionable entry point if you're looking to get into these markets, just as important, it is a good canary for the rest of the markets globally. Again, when the leader who breaks out pulls back and holds, that makes you think any pullback in other markets will hold as well. Finally, regarding our COVID-19 stats of the week, we pulled this slide from the First Trust website, and I highly recommend anybody interested in the topic go look at some of their previous slides. The top left chart with the A block is the 7-day average of both cases and deaths, and you can see both are well off their January highs, literally 75% since that peak. While they're flat this week, no real change, they certainly haven't seen the uptick or the doom that was foreshadowed by the director of the CDC a month ago. The interesting stat from the CDC that came out last week, however, is in the top right at the B, and they reported that mental health related emergency room visits from children ages 5 to 11 and 12 to 17 was up dramatically over the 6 months from March 20 to October 20. So again, the pandemic certainly had some mental health issues on our children. On a more positive note, the green box here down by the C denotes that the Texas Rangers have opened to full capacity. So far, they're the only stadium to be open at full capacity. Hopefully others will follow soon. And finally, in a little more quantitative data, this map on the bottom left is color-coded by the number of beds that are being occupied by COVID patients. The light blue is a state where 5% or less of the beds are being occupied by COVID patients, and that's certainly the majority of the country. If you throw in states like Texas, Colorado, Oregon, Washington, Florida, Georgia, the vast majority are 10% or less, and that's obviously very good news from the point of view of the pandemic winding down and us all getting back to normal. So in summary, the big news last week was obviously in copper and corn and commodities in general. Yes, the weaker dollar had something to do with it. But again, when you have copper trading at a 10-year high, as you can see here in this green circle on the left, and a 12% up week in many of the agricultural commodities, you really have to believe the reflation trade is kicking in, and potentially the conversation may become inflationary in the weeks ahead. The good news in interest rates is that the 10-year US Treasury is back through that 140 area. That's good news for the recovery and the reflation trade as well. The spreads with high yield credit and investment grade credit are not flashing any warning signs, which is something we like to watch. And accordingly, the market's healthy. Despite the headlines and the gloom and doom crowd out there and people saying that the Biden tax cut is going to tank the markets within the next 30 days, the markets haven't read that memo yet and they remain strong. If you look at the S&P 500, you're seeing strong breadth, strong leadership. And again, it looks like a market that's in about the third inning of the game. Certainly we could have a pullback, and you can argue one's due here. I think it comes in a couple of weeks, but any pullback should be considered viable, and any consolidation range, just really a digestion of the gains and no major market top. Reason we say that is because of the risk indicators on the right. Again, look at copper, look at the copper to gold ratio, look at the ratio of Dow transports to Dow utilities. The yield curve has steepened significantly, and the ratio of consumer staples stocks, or I'm sorry, consumer discretionary stocks to consumers staples stocks remain strong as well. So people would rather buy CSCO Cisco, not SYY Cisco. And typically when they're buying SYY, it's because they're nervous about the markets. Finally, Chinese markets are holding support as well, which is also very, very good news for the bulls. So I've been Mike Hurley, market strategist with NexPoint. Thank you for attending our deep dive on the markets for Monday, April 26th. I hope we get to see you next week. Thanks so much.